In the last video, we talked about merger and acquisition tax as a profile for chartered accountants. Now, in this video, we're going to talk about 5 most important questions that can be asked in your interviews, which you must be prepared going into the interview. So, let's begin. So, the first on the list is 5627B, or the so called angel tax. It was introduced to prevent companies from raising excessive capital on valuations that do not match with their books. It caused a lot of hardship for startups which are raising valuations based on their future earning potential, as they do not really have any source of revenue right now. It's only about the idea. So 56 to 7B is very important in M&A tax, as any deal which is involving raising of funds by a startup, or VC funding a startup, or private equity going into a business, you need to understand that they will buy shares of the company, and those most of those companies will be closely held companies. A lot of them will not be startups, and so 56 to 70 will play a very important role. One of the important questions that you can be asked is, let's say a company raises money at face value, but its valuation is less than face value or negative. Will this section apply? The answer is this section will not apply in this case, because 56 to 7B talks about money raised in excess of the face value. And also Companies Act 2013 requires companies to raise at least at the face value. So 56 to 70 will not apply in that situation. So the next section we are going to talk about is Section 79. Section 79 requires that for closely held companies to be able to set off carry forward losses, the year in which the losses incurred, and in the year in which they want to set off those losses, the person holding 51% of the share capital must continue be holding 51% of the share capital of the company. So the shareholding of the person as on the last date of that previous year in which the losses were incurred, and on the last date of the previous year in which you are carry forwarding and set off of those losses must be same. Now, an interesting question that I was asked in my interview was, let's suppose there is a company named B Limited whose 100% shareholding is held by A Limited, and A Limited's 100% shareholding is held by Mr. A. Now B Limited has losses. Now during the previous year, Mr. A sells the shares of A Limited to another person, Mr. B, and now he does not own Mr. A has 0% holding in A Limited, and Mr. B completely owns A Limited. So will B Limited be allowed to carry forward the losses? The answer is that the owner of B Limited continues to be A Limited, and so there is no change in ownership, and so Section 79 does not apply, and so B Limited can continue to carry forward and set off those losses. Now let's talk about Section 47. Section 47 is very important section for capital gains taxation. For any gain to be taxable as capital gain, there is one important condition, that is, there must be a transfer of a capital asset. Now, Section 47 provides certain cases which will not be considered a transfer under the Income Tax Act. So, if there is no transfer, there is no capital gains act. So, Section 47 is very important because it provides various scenarios which allows companies to transfer assets within their organization, or to transfer to different organizations, or other conditions such as amalgamations, mergers and demergers, which will not be taxable as capital gains because they are exempted as transfers under Section 47. The most important subsections to note here are the transfer between holding company with its wholly owned subsidiary, both up and down, demerger, both Indian and foreign, amalgamation and merger, and also the impact on the shareholders of demerged and merged companies. Next on the list is Section 195. Section 195 requires for deduction of TDS on any payment made to the non-resident which is taxable in India. Now the important sections to note along with Section 195 is Section 9, which is whether that income accrue or arise in India. Section 115A, or for royalty and FTS, that specifies the rates of taxes. Then comes DTAA agreements, which we have to see whether that income is taxable or is being given an exemption in the DTAA, and also the rate of tax provided. Now, important thing to note here is that the payee must be a non-resident. The payer can be a resident or a non-resident. Another important question that you will be asked from Section 195 is the Vodafone case law, because in that case also Vodafone was deemed an assessee on default for not deducting TDS under Section 195 while making their payment. We will be making a detailed case study of that case law very soon. The last question on the list is Section 50B. Now, as we also mentioned in the last video, a form of internal recognition for companies is the slump sale. It allows companies to transfer assets between their two group companies without having to transfer their ownership, or it also does not require them necessarily to go through a court process. So, slump sale is a very popular process for companies to move assets within the organization. Now, for slump sale, there is a specific computation which is given under Section 50B on how to calculate capital gains for that. And for that, we have to remember three things. First is the consideration that is received. That must be a lump sum consideration. The value of assets that are transferred in accordance with this section and Rule 11 UA, and the net worth as computed in accordance with this section. So these are the 5 most important questions. Now let's go on to a bonus tip for you. Before going into any tax interview, you have to remember the new sections that have been added to the chapter of TDS TCS. Plus, you have to also go through any new amendments in those sections. For example, 206C1G has just been amended. Further, there was section 194R which was added last year. These two will be favorite questions of interviewer in the current moment. Plus, if you are giving your interview closer to budget or after the budget, then one question that you will get in pre-budget interviews will be what are your expectations from the budget? And in post-budget interview, you will be asked what were your key takeaways from the budget. Both of the times you have to remember that your expectations and key takeaways should not be about individuals, but must be more towards the corporate sector, as the company that you are giving interview are more interested regarding the corporate sector than your personal individual needs. So I hope you enjoyed this video. Thanks for watching and press a like if this video was worthwhile for you.